Hello, welcome to Wander Financial. Today we're discussing options, and in particular, put options. We've discussed call options in the past, but here we're going to talk about puts. The difference being it's just the exact opposite. In the case of puts, we're expecting the price of the stock to decrease. If we buy puts and the stock goes down, our put price will increase. So, let's take a look here at a chart. Let's say NVIDIA. It's coming off of the 200 day moving average. Perhaps we think it's going to drop back down to the 50 over the next couple of weeks. So we're looking at a current price of 168, looking for it to go down to about 155. There's two ways you can trade this. One would be to actually short the stock. In general, it's not the easiest thing to do, especially for beginners. Some accounts won't be able to sell stock. So anyways, another option then is put options. Puts give you the right, but not the obligation, to sell the stock, 100 shares of the stock per option, at the strike price, expiring on the expiration date. So let's take a look at an option chain for NVIDIA and see what that would mean. Okay, so NVIDIA, this is an option chain. On the right side here are the puts. Now, this is well, let's start with this. 168.44 is the current price. If you were to short 100 shares, you would be shorting $16,844. That's at least what it would cost you. Generally, to short stock, you're going to have to pay a little extra as well with your broker. So anyways, you're going to need to put up a lot of premium, a lot of money right out of your account. A different way, a way that provides leverage, is to buy one put option. Buying one put option would give you, again, the right but not the obligation to sell 100 shares, in this case at $170, that's the strike price, expiring on August 2nd. Okay, so we've got a couple weeks left. Again, we expected stock maybe to drop to 155. So if that happened, if the stock dropped down to 155, then these options, 170s, would be worth $15 each, versus the $5.10 that they're at right now. Let's just call it $5. They cost you $5. That means $500 because it's 100 shares. So it's a $500 premium is what you would pay for these. And we're expecting it to go to 155, and if it does, now they're worth $15, meaning you made a $15 minus $5, $10 profit per share, $1,000. Now, if the stock instead goes up and settles above 170, then these options are going to be worthless, and your premium, you will lose the whole premium. But on the other hand, it doesn't matter if the stock goes to 171 or 200. Either way, the most you can lose is the premium you paid. Okay, so we're looking for the stock to decrease in price. Again, this is a put option, naked put, so all we're doing is buying one put at 170, giving you the right to sell the stock at 170. Now, if the stock goes to 165 on expiration on August 2nd, it's going to be worth $5. So you're basically going to break even. That's your break even point. However, if it goes to 160, you'll make a few dollars more. If it goes to who knows, 100, you will make all that profit. So the profit, the upside is essentially unlimited, while the downside of the option that you bought, you can never lose more than the premium you paid. So again, to recap, this is a very basic explanation. On puts, you are expecting the price to go down. You're looking for the strike price of the stock here in NVIDIA to go from 168 down to 155. You're looking for it to decrease. You're paying a premium for that. You're paying $5 for the 170 puts, even though right now they're only worth $1.56 because the current price is 168.44. That means they're $1.56 in the money. But you're paying $5. The seller of these options, this person that sold these to you, is requiring an extra premium because he's accepting the risk. So we're looking for the stock to go down by buying puts. If it goes up, our risk is limited to the amount we paid. And that is the very basic explanation of puts, and we have a lot more to talk about, but I'm going to leave it at that for now. Thanks for watching. Thanks for watching. Don't forget to subscribe.